Which one gets better returns, 401ks or Airbnbs? In this video, we're going to get into it. I'm going to give you a specific example of one of my Airbnb properties so you can see exactly what kind of real world returns I'm getting so you can make your own conclusions. I have been a W-2 employee up until 2020. I was a W-2 employee for 22 years, running other people's restaurants. I invested in 401ks and I built it up, and I kind of bought the 401k line, hook and sinker, about just put all your money here, park it here, and then when you're freaking old as crap and you're retired, and hopefully you still have some like physical energy to spend this money on, you'll have a great quality of life. In the meantime, work your freaking ass off for 40 plus years for somebody else, and then talk to us much later about your money. So I bought that line and I did that. However, when I became self-employed as a notary signing agent, and then later as a signing service owner, and then later as a real estate investor as well, I realized that I wanted control over my money and my investments. I was like, okay, well, it doesn't make sense anymore mathematically to contribute to a 401k when I can control the asset, control the investment, and get much better returns. I didn't know how much better, I just knew it would be better. I just couldn't quantify it until I bought my first one, right? So I'm gonna give you an example of my most recent purchase in Pigeon Forge, Tennessee. The address, you can look this up on Zillow. However, Zillow has it slightly misclassified because it's a new community. So you'll actually be able to find it on Zillow, 223 Lily Court, Sevierville, Tennessee. I'll have a link to it, my Airbnb link at the bottom, and I'll link the Zillow listing as well, so you can reference the property and kind of play along as we're going through the numbers. So you can see it is real life numbers and not BS and smoke. I can show you exactly what's happening. On the 401k side, I invested every year for most of those 22 years that I contributed, and I had built up maybe, I don't know, 150,000 or so, and that was over 2 decades. So I had annual returns somewhere in what historically would be the 5 to 8% range. And that's pretty normal. Most people would say 8% if it's depending on how it's invested, conservative, not conservative, stocks, bonds, what the split is, but somewhere in that range. Now, even if you have, separate thing, if you have returns of 5 to 8% every year on average, it doesn't mean that is going to be your cumulative net return, right? So for example, if I, in year 1, contribute 50 grand and after the full year, I'm up 50%, now I have $75,000 in my account. And let's say the next year I'm down 50%. I actually have 37.5 in my account. So 75,000 divided by 2, 37.5, even though I started with 50. So on paper, I'm at a average return of 0%. However, my real return is down 25% because I was at 50 and now I went down to 37.5. So that's why when they tell you on paper your average returns, they're not talking about cumulative when you add it all up, what your actual take home is or what it actually nets to you. That's just on paper averaging out the years, not really averaging out what the impact is on your account. So if you really do the cumulative return, it's probably less than 5%, which is freaking scary to have a 5% return working your ass off for 20, 30, 40, 50 years and then not having a ton to show for it. Crazy, right? So at that time I was like, okay, look, there's got to be a different way. Obviously now I'm self-employed. I could contribute to a self-directed 401k, which I did initially because I didn't know any better, right? And it was a self-directed Roth 401k because I didn't want to be taxed on the gains. So, okay, great, I'm gonna do that. But then when I was like, okay, I'm gonna definitely start investing in real estate, I didn't want to use a self-directed Roth. The problem is with self-directed, even though you can purchase real estate out of it, you lose all the tax savings, which get really big with real estate. So I decided to liquefy that, take those funds out of the self-directed so I could use them for investing into rental properties, specifically short-term rental properties in vacation markets, to rent the property out on Airbnb and VRBO. So cabin number 1, Cora's cabin, was a 3-bedroom, 2-bath. I'll link that also in the description below so you can check out that cabin. And the one we just most recently bought in the middle of October of 2023, Raleigh's Retreat, and both those cabins are just named after our kids. Raleigh's Retreat, it's a pool cabin, 4-bedroom, 4-bath. And you'll see that in the description below. But the actual purchase price was PP $859,999. That was what the sellers were asking for it. That is what we paid. And you're like, well, Brad, why did you buy it at full price? Well, to be fair, I know that market very well. So for a 4-bedroom, 4-bath pool cabin, even though it's a very small pool, it's great for the kids, pool cabin in this market, 15 minutes from Dollywood, 15 minutes from Pigeon Forge, 25 minutes from Gatlinburg. In the location it's at, it was incredibly underpriced. Normally, when I bought it in October, those similar properties in slight, maybe like 2-3 minutes closer in different neighborhoods. This is a brand new neighborhood, so not a lot of history. So people are guessing at how great it's going to be as far as location. Normally in more developed neighborhoods where people already kind of know what annual returns are on certain size properties, this would be purchased somewhere closer to $1 million. you know, maybe in 1.1, 1.05, but you know, so for $860, it's a freaking steal. So I bought it for list, but my one caveat was through the sellers that you're going to pay my closing costs, and I'll be glad to pay list, which is what they did. So our closing costs were very low because we went with a local lender. They were around 2%, but the sellers covered it. So I just had to come up with the down payment. It was a 20-year, as far as the loan type, it was a 25-year term with a local lender. It was a commercial product, so I could buy it in my LLC, which is how I like to buy them. And then as far as the terms, because it's a ARM, so it adjusts every 5 years. So the first 5 years is fixed, and then after that, adjusts every 5 years thereafter. And that is at an interest rate of 6.375 or 6 3/8. So at the time in October, when rates are literally the highest they were in 2023, and everyone quoted commercial 30-year terms were being quoted with points at like 8% or higher. To me, also I forgot to mention, no points. No points, only 2%, less than 2% in closing costs, and then, which the seller covered, and then 6.375, I was like, yeah, hands down, slam dunk. So that's the benefit of going with a local lender. So anyway, purchase price $859,999. Let's get to the numbers. So what are the returns? So real estate, there's really 4 returns that you actually get, unlike a 401k where it's just the return that you're seeing on paper at the end of the year. So there's the 4 returns are in real estate: appreciation of the property as the property goes up in value with you doing nothing, the mortgage pay down by the renter. So whether that's short or long-term renters, the renters are paying the mortgage down over time. The cash flow, so that's what most people are familiar with. How much money is the property spitting off after you pay the mortgage and debt servicing, after you pay the cleaners, the any repairs and maintenance, the water bill, the electricity bill, the cable and internet, what is left over coming to you. And then lastly is your tax savings, which is incredible with real estate. It's the only class, other than possibly commodities and oil and farming, it's amazing returns. So we'll cover that in a second. So first off, appreciation. So as far as appreciation of this property, this market is a little different because it's a niche market, because it's a vacation market. So typically prices fluctuate a little bit more wildly one way or the other, depending on if it's a seller's market or a buyer's market. Now in this case, the buyer's market, it's been like that for about a year or so in that market. Overall, it's been a buyer's market, you know, closer to 2 years, but in that market, about a year where sellers have been like, okay, we'll concede and start paying some concessions and be negotiable. So for about a year, and prices have come down a very small amount, nothing dramatic. I would say probably overall the last year, maybe 5%, 10% tops, okay? However, now as their interest rates are coming down, those will quickly reverse back to where they were pre-2022. So anyway, appreciation historically from the Federal Housing Finance Association, from the government, over the last 36 years, the average US house, as far as appreciation, annually, the increase is about 4.8% on average. That's factoring all markets, all United States, the last 36 years from 1987. So 4.8%. Okay, so that alone right there, if you buy real estate, what does that tell you? If you're buying real estate, your returns, from at least from factoring in appreciation, are pretty close already without doing anything else, assuming you buy at a good market. Number 2 is going to be the mortgage pay down. So unlike long-term rentals where there can be vacancies, and there always are vacancies, it's just how long are the vacancies, right? Where there are times where it's not getting paid down consistently every single month. With the short-term rental and vacation markets, I don't have that issue as far as long vacancies because our occupancy rates are 70 to 80% or more, depending on the month we're talking about of the year, because there's seasonality. And I'm not kicking anybody out. In other words, I don't have to evict anybody. People are gladly leaving on time. The average stay, depending on the property, this property, the average stay is about 4 to 5 days. So 4.5 days on average, because it's a larger property. So I would say mortgage pay down in year 1. So again, I had that 25-year term from my initial loan balance of $687,000. Plug that in the calendar, the mortgage calculator. At the end of 12 months, the tenants, or in other words, the vacationers, had paid down the mortgage 1.7%. So those two together, that's about 6.5% return. So we're basically still on par with a 401k. So nothing exciting yet, right? Okay. Next part gets much more exciting. So stay tuned. Don't jump off. This is the really exciting part. Cash flow. Okay, cash flow for a long-term rental property where there's a lease, cash flow is going to be generally pretty minimal. That's why bigger investors are buying massive apartment buildings, because they get the economy of scale. Instead of one renter, they're getting 300 renters, so the numbers get a little bit more sexy. With a short-term rental, the nice thing is, even though the purchase price is much higher than a traditional long-term rental, depending on what market you're buying in. You know, if I'm buying in, let's say, the Midwest, and I'm buying a 3-bedroom, 2-bath to rent out on a long-term model, I would say, you know, maybe I'll cash flow, if I buy it for $300,000, $350,000, maybe I cash flow using the 1% rule, $350,000, maybe, you know, Midwest is a little higher, let's say even $600 bucks a month. Not sexy for $350 grand purchase price. Pay a lot more, however, the cash flow is much more sexy in this case. So on our pro forma for this property, and it's been proven out so far for the first 2 months, it's been rented out since October. And we're now at the very end of December of 23 for perspective. But the pro forma, if I can link it in its Excel sheet, so I'll link that as well below. And then you'll see that my numbers exactly. But the pro forma on this, the gross annual revenue will be about roughly for 2024, first full calendar year, approximately $161,000. So you're like, oh shit, okay, that's a lot more than I was probably expecting you to say, Brad. Yes, short-term rentals in this market, because this is the #1 vacation market in the United States for decades, because of the Smoky Mountain National Park, if you're not familiar, draws 10 to 13 million visitors every year annually. If you look at a chart of, let's see if I'm facing the right way, there we go. It's slowly increasing every single year, including down years as far as economic macro recessions. People continue to come here because they drive to this destination, they don't fly here. So when things are tough, they're still going here because they're just getting in their car and driving, and it's just gas to get here. And then as far as the actual cash flow, when I pay off the mortgage for the whole year, and really the renters are paying that. I pay my cleaners, I pay my pool person, I pay the water, I pay the cable bill and internet. What I'm going to cash flow roughly is $63,000 on this one property. So $63,000 divided by 12 months. So on average, every month it's going to spit out approximately a little over $5,000 a month to me. Awesome. Love it. But what did I pay for it? Down payment was 20% of $860. It was $172,000 is what I had to come to the table with. And when I say we, I mean myself and my wife, Jess, had to come to the table. So divided the cash flow, $63,000, by the down payment, $172, and that's a 36.6% return. So this is where real estate, depending on the niche you're doing, in my case, short-term vacation rentals, dramatically whoops the ass of any 401k or any long-term rental real estate property. It's not even freaking close. If you get in the #1 market or #2 market or a really good market and you can manage it well. In other words, I don't pay any property management fees, which I didn't get into because I self-manage it. And I'll do many other videos on how to self-manage that. It's a smaller niche, so there won't be a ton of videos, but I don't spend a lot of time managing both properties. I spend on average every week, you know, on the low end, probably 2 hours, on the high end, 5 or 6 hours, you know, well, probably on the high end, 10 hours on average. And that includes visits to the property when we're going on vacation, and any time I spend there, maybe doing small updates and stuff like that. But there's very little time. Okay. So as far as the actual return, 36.6%. So that we have leapfrogged past the 401k. It's not even close now. And then lastly, I'm going to touch on the tax savings. So the way the tax savings are incredible with real estate is because there's a thing called, well, two things. One, the IRS allows for depreciation of a rental property. They know that things will break down over time. So the very cheap way to do it is the IRS will give you the one standard method, which is you can divide the purchase price of the property minus the land, because you can't depreciate land because it's always going to be there, minus the land, the value. So in my case, the land was roughly, I don't know, 70 or 80 grand. So let's just say 780,000 left with the actual like structure itself, divided over 27 and a half years, and I could deduct that every year. Great. I don't know what that is. You know, probably about 780 divided by, I don't know, it's probably like, I don't know, 15 grand a year. So it's not bad. However, the other way you can, sorry if the math is terrible, but the other way you can deduct this depreciation that the IRS allows, the second method, which is the method that I use and most real estate investors will use if they're smart, is the straight line depreciation method. Because the IRS knows that, okay, great, the house will depreciate over time, over 27 and a half years. However, things in the house would appreciate much faster. So the carpet, the cabinets, the dishwasher, the hot water heater, all those things will appreciate much faster. So the IRS breaks it into buckets, a 5-year, a 10-year, and a 20-year bucket, things that would appreciate faster than 27 and a half years. So what they will allow you to do, if you order a cost segregation study from an engineering firm, the engineering firm will come out and an engineer will literally inventory every little thing in your house from, I mean, they're super detailed. So both the, everything I already mentioned, as well as landscaping, the concrete pad of your driveway, your deck, your steps, and then inside all the different systems. So basically they'll inventory everything that isn't the actual frame of the building. Besides the walls and the roof, everything else they will inventory and break into the 5, 10, and 20-year buckets as far as, depreciation tables. They'll send that to your accountant. You have to have a good CPA here that knows real estate. And they'll send that to the accountant, and the accountant will then put it in the right buckets to make sure they are in the right buckets. And what that lets you do is appreciate those items much faster. So instead of everything over 27.5 years, the same every year, in years 1 through 5, you're deducting, much bigger chunks because you're getting those appreciation write-offs faster. And also there's another thing called bonus depreciation, which you may or may not have heard of. That actually allows you to take a much bigger chunk in the first year you put the property in service. So for instance, up until 2022, because of the Tax and Jobs Act from 2017, for 5 years, we were allowed to, in the first year of service of the property, bonus depreciate 100% of the property in year 1. Whatever was in those categories of, not the frame of the building, but everything else. So that would be the building improvements and the land improvements, not the building itself. So as far as the Tax and Job Cuts Act, that changed. So now it's actually 2023 is the year I'm filming this. So it's actually now it's only 80%. So what in the world does any of that crap mean? So what it means is when I have the engineers go out, they do their study, they do their inventory, they send it to my CPA, he puts it in all the buckets. Great, that's straight line depreciation. With bonus depreciation, that allows you to take a much bigger chunk in year 1. So for instance, it ends up being roughly 20 to 30% of your purchase price. Roughly on average, depending on how good the engineers are and how detailed they are. So for instance, the purchase price was $860,000. Let's say 25% of that will actually be deductible in year 1. Now, 25% of 860 is 215, roughly. 215,000. So up until 2022, I could deduct 215,000 in that first year and actually offset that against my active income because I follow the IRS rules to do that, showing that it's an active business. Another video another time. However, because it's 2023, I only get to deduct 80% of that 215. So 80% of 215,000, you get 172,000. So there you go. So $172,000 in tax savings. So what does that mean? That means I get to offset $172,000 of active income between myself and my wife. My wife's W-2, she's a nurse, and my businesses and the real estate income. So now that's not dollar for dollar. Obviously, it depends on what bracket you're in. This will vary, obviously, depending on what tax bracket you fall in and what your cumulative tax amount is. So when you average it all in. So let's just say roughly it's 20%. A lot of people fall in that, a lot of, middle America falls in that 20%. Cumulative, there may be in the 24% bracket or 30% bracket, but when you average all the income in, it's roughly 20%. And that's just federal, not counting state. If you have state tax, it's even more. But 172,000 times 20% tax bracket is $34,400 in taxes I did not have to, or I won't have to pay for 2023 federally because of this deduction, bonus depreciation deduction on this rental property. So when I add that $34,400 in taxes I don't have to pay Uncle Sam, federal, divided by my down payment of $172,000, my 20% down, that return is 20%. So now between appreciation, mortgage pay down by the renters, the cash flow coming at me every month, and the tax savings, when I add all those returns up, the total return for this particular Airbnb is, in year 1, is 63.1%. And that number, as far as, is it sexy or not compared to 5 to 8%? I mean, come on. So this is why it gets really sexy. Now, year 2, it looks a lot different because I took out that massive deduction in year 1. So year 2, the tax savings number definitely drops down. It might, instead of 34,000, it might only be, 10,000, which into 172 is more like, 1.7%. So, that'll drop from 63 to maybe 55%, or I'm sorry, 45%. Still good in year 2. And actually it may be more like 48% because in the second year, cash flow increases because the rates I increase slowly over time. And that's pretty normal in that market because rates continue to appreciate what we charge for vacation. So yeah, I would say 63% in year 1 to average return on the 401k. It's not even close when you factor all those things in. And again, I'm not working a lot to manage both these properties at all. This is just one property. So very minimal work from home. It's all automated. I'll shoot videos on that, but hopefully this enlightens you a little bit on why people even bother with short-term rental Airbnbs. And this is a property I own. This is not arbitrage. I own this so I can get the tax deductions and I have the control of my investment. So this is the whole point of why I decided to go this route, because here I have no control, right? So let's take it to the end game. I'm 41 years old. If I was still investing in 401ks, even if it's Roth or self-directed Roth, I can't play with that money until I'm 59 and a half. So that would mean from age 41 to 59 and a half, let's call it age 60. The next 19 years, I would have to continue to contribute, and that 401k would spit off what in returns to me? Nothing. It would just be sitting here in the account. I can't touch it. If I do touch it, there's a penalty for early withdrawal, and then I'm paying taxes on it, depending on if it's Roth or pre-tax. However, in this scenario over here, I'm getting that cash flow of $63,000 or roughly $5,000 a month. So I'm getting $5,000 a month cash flow for the next 19 years if I hold it that long. So that's $63,000 a year times 19 equals $1,197,000. $1,197,000 is what this property will pay me over the next 19 years. Think about that for a second. Okay, and 19 years, what's the value of your 401k or 403b or your retirement plan going to be? If you're lucky, it will be over $1 million or maybe $2 or $3 million. If you're lucky, but you don't get to touch that. That 2 or 3, whatever it is you build up in here, you know, let's say it's 3 million. Let's give you some props. You know what you're doing. Let's say it's 3 million at retirement at age 60. You want to start pulling from it. Okay, but if you're going to pull from it, you want to live off of it, 3 million. And I think the 4% rule is what a lot of people use. So you can pull 4% of it out annually, assuming you're getting at least still a 4% conservative return, or 3%, sorry, 3% was my bad. 3 million times 3%, 90K, okay, perfect. So 3% rule, 3 million, meaning you pull it out, but the compounded returns still keep the principal the same. You're not drawing from the principal, you're just living off the interest. So that would spit out 90,000 a year. Fantastic. So you work the next 19 years at your job and contribute to your 401k. If you do really well as far as an investing standpoint and you're contributing a large chunk and you're being conservative in your day-to-day and you're not spending a lot of money, you'll maybe have a nest egg of 3 million by age 60 in that retirement account. Fantastic. And then you're going to pull out 3% so you can live off the interest. So the principal isn't coming down, that way you got that nest egg there just in case. So you're going to live off at age 60, $90,000 a year. Awesome. Spoiler alert, in 19 years, that $90,000, what is the buying power of that? Well, with inflation, it's not going to be great, unfortunately. So that buying power in 20 years, basically, you know, it might only have the buying power of 60,000. And it could even be less depending on how much money is being printed by the government. I mean, at the pace they're going, it might only be worth buying power 45. So you wait 19 years and then you take a pay cut from your normal job. And, you know, so that's what you have to look forward to. Versus on my end, if I have control of the investment and I'm investing something that's giving me a much bigger, massive return that I control over time, every year it's spitting out cash, this is much more sexy here. Oh, you know, so by the way, if that hasn't made it clear, why you can crush returns on Airbnbs that you own, not arbitrage, that you own if you're in vacation markets and stick to the best ones and you self-manage, you will absolutely destroy your returns in your 401k. And it's pointless at that point. If you're willing to go that route, it's pointless to contribute. So full disclosure, I have $0 in the 401k or any retirement plan, because my retirement, I have 2 plans. There's 2 cabins paying me every year already $100,000 in cash flow, and then I'm continuing to add 1 property each year is the plan. So in 2024, we plan on adding a 3rd property. So that's spitting out money. You know, I don't have to do my businesses. My businesses run automatically. My real estate runs almost automatically. You know, if I have 10 properties at some point, yes, I'll probably hire a virtual assistant or W-2 employee to run those for me, just to do those handful of hours a week, 10 hours a week, whatever it is, messaging guests here and there and communicating with cleaners. And I don't have to work for it. It's just coming to me. So if you see the vision, if the light bulb is going off and you're curious about short-term rentals investing, leave comments below, ask questions. You can also find me on my social media handles and just try to reach out and contact me, or if you don't know, just ask in the comments below. I would love to understand your thinking of why you want to contribute to a 401k for 20, 30, 40 years versus trying to own real estate that spits out cash flow. And I get it because I've been there. For 20 plus years, I was that guy contributing 401ks and living that Dave Ramsey life. I love Dave Ramsey, and the budgeting is very important, and living below your means and staying away from high interest. I agree 100% with Dave, but the rest I don't, because my risk tolerance is totally different, because I would rather have control over my investments and control over my future. That's why I'm self-employed. That's why I invest in real estate. And it's very doable. This part, not the business part, but the short-term rental part, very doable for almost any W-2 employee. As long as you're good at customer service, you can crush it over here self-managing an Airbnb property, 100%, assuming you buy right, buy in a good market, know what to look for. Again, different video, but you can do all those things. So please think about investing in Airbnb properties. I promise you, you will not be disappointed. If this video brought you any value, hopefully it opened up some eyes for you. We're 30 minutes into the video. If you have stuck around this long, thank you so much. And I truly, truly, truly appreciate you. If you can, like the video, and if you subscribe to the channel, that would help me out tremendously as well to make further content on all things entrepreneurship and all things investing. And I always speak about things I personally know, so you can know I'm not just blowing smoke. So until next time, thank you so much for tuning in, and I will see you guys on the next video.